Well, hello. I'm Anthony Siccaro, founder and president of Providence Financial and Insurance Services, and also founder and president of Anthony Siccaro Law, which you can learn more about by going to anthonysiccarolaw.com. I'm also host of the Providence Financial Retirement Show, which airs every Saturday morning on AM 870 KRL Lays the Answer, and you can listen to that at 9:30 a.m. Or you can catch those shows when they replay on our podcast on Mondays. And our podcast site is providencefinancialpodcast.com. And we have hundreds of shows on there, all retirement related. Well, periodically, you know that I like to do videos for you, my loyal clients. Thank you for being a client. Thank you for your trust in us. And I like to bring you up to speed with things that are going on. So here we are, December 22nd. Hard to believe we just have a few days left until Christmas. And I'm going to take a little bit of time between Christmas and New Year's. I'll be out all the way from tomorrow until January 3rd. We will be fully staffed during that time, though. So any questions you have, you're going to get answers to those questions, as everyone else will be here. And I wanted to take the opportunity to do two things. One, I want to wish you all a Merry Christmas and a Happy New Year, and look forward to getting involved in next year. The second thing is I want to just give you a quick update as far as what I think next year and maybe even the following year is going to look like. And I've done a number of TV interviews recently. If you haven't seen those, we put them all on our website. Feel free to go to our website, providencefinancialinc.com, and they're all there on the homepage. You may want to watch some of the things because I, give some pretty good insight. But let me just sum it up as to what I think is going to happen next year and then what's going to affect you. And maybe we'll even, matter of fact, I think a good place to start is to even touch on what happened this last year as well. And so most of you know this last year, the interest rates have gone up and your bonds or your fixed income portfolios have gone down. And that's what happens. Fixed income portfolios will react opposite of interest rates. So when interest rates go up, fixed income portfolios come down. And when interest rates go down, fixed income portfolios are going to come up. And that's the way that they work. Fixed income, the value is going to fluctuate opposite of interest rates. Well, some of you know that interest rates have grown dramatically over the last year. We started off the year at 0.5% on the Fed funds rate, and now we're at 4.5% on the Fed funds rate. That's just massive, massive. Without me doing the math, I think it's like 20-fold or something like that. Or actually, it's a lot without me pulling out a calculator. But the bottom line is that it's been massive growth. So fixed income portfolios took a hit. At least the actual balances took a hit. Now, from past videos and conversations that if you're getting income from your portfolio, your income wasn't affected. So it doesn't matter the fact that your portfolio value went down. It just fluctuated down. You didn't lose money. It just fluctuated down. The only time you lose money is if you sell. And if you're living off your income, if you're living off the eggs, then it doesn't matter what the value of the chickens are at any point in time, because no matter what the value of the chickens, they're still laying the eggs that you can eat. So if you're getting income, it doesn't matter. On the other hand, if you're reinvesting your income, the good news is that because your portfolio has gone down, because all the investments in your portfolio has gone down, you've actually been getting a discount on all your reinvestments over the course of the last year. So no matter how you slice it, dice it, the fact that the portfolios have fluctuated down either haven't hurt you, they've been neutral, or they've helped you if you're reinvesting your portfolio. The only time they're going to hurt you is if you need to sell, if you need to cash out. So, but you've seen them fluctuate. And yet, even as much as I've told this story, and you've heard this story before, this is nothing new, it's just a kind of a continuous reminder. But even as much as I've told the story, sometimes you get your statements and you get heartburn anyway. It's like, I know it makes sense. I know that I'm investing, but I want that number to go up. We want that number to go up, but, and then when you see it fluctuate, you see it go down. Some of you, have gotten heartburn over that. Not a lot of you, by the way. I think most of you understand, but once in a while, we get a call from someone that's just not sleeping well because of it. And if that's you, if you've seen all the fluctuation and logically it makes sense, but emotionally it's just eating you up, call me. Call Twan, let us know. We're more than happy to talk about what do we do, because nothing's worth not being able to sleep at night or not having a peace of mind, even if logically it's the right thing to do. So if some of you have been kind of suffering through it, and you've kind of been like, maybe you want to call me, but then I put out a video and you're like, no, I'll just wait to see, and it's kind of emotionally tugging on you, please call us. Talk to Tuan. Since he'll be in next week, I won't. And we'll see if there's any changes we can make. But the bottom line is that that's what's happened all year. Now, October wasn't a great month for portfolio fluctuation. But November came back. December, it's kind of hung around the same level. If things stay where they are, November bounced up a little bit. December, you might even see a little bounce on your statements when you get those statements in January. We'll just see where the end of December is. But, and interestingly enough, for those of you that have stocks in your portfolio, the broad market is down about 20%. I think it's a hair under 20% as of today. Matter of fact, I think it's just a hair under 20%. The broad market, the S&P 500 is down 20%. The stocks in our portfolio are down, I believe, less than 3%. That's huge. So while the market's down 20%, our stocks are down less than 3%. But meanwhile, our stocks are giving you a 3 or 4% dividend, whereas the S&P 500 is only giving you about 1.4% dividend. So significant difference in dividend from the portfolio that we offer, that we've been giving you in compared to the S&P 500. Significant difference in income and significant difference in the fact that that the S&P 500 is down 4 times as much as our portfolios. The fluctuation that you've all seen in your portfolios hasn't had to do with the stocks that you have. It has to do with the bonds. And that's ironic because you're supposed to be having the bonds to keep the value of the portfolio the same. It just hasn't worked that way. And yet again, it doesn't matter for all the reasons that we talked about. So that's kind of where we are now. Going forward, I expect that in the latter half of 2023 or 2024, maybe the first part, that we go into an official recession. And there's a couple of reasons for that. The bond market is telling us that we're going to have a recession. And I don't want to get into the inverted yield curve that we have. I've done podcasts on that. You can go listen to my podcast, providencefinancialpodcast.com. And I do talk about inverted yield curve and what that means. And an inverted yield curve essentially is where someone would be willing to invest their money for a short period of time, or actually can get a higher rate for a short period of time than they can for a longer period of time. And yet there are people that are willing to lock up their money for 10 years at a lower interest rate than they can get if they lock their money up for 2 years. So why would they do that? Well, it tells us that they think that in 10 years, they're not even going to be able to get the interest that they can get right now. And so that is telling us that we probably have a recession coming. When you look at the history of inverted yield curves as significant as we have now, there's, on a high percentage of times, a recession has followed. So the bond market's telling us we have a recession. The other thing that is likely to cause a recession is the fact that the Feds are not able to get the inflation rate down at this point. Now, they've got their foot on the gas. They've told us, Jerome Powell and company have told us that they're going to keep raising interest rates until inflation comes down. The challenge is for the last 5 months, we've started to see a softening of inflation. Inflation is coming down, but inflation is a lagging indicator. What that means is when you do something now, it takes a while for it to show up. So what the Federal Reserve did in raising interest rates 3 months ago doesn't show up for 3 or 4 months in the actual numbers. And the Federal Reserve doesn't seem to be allowing for the inflation numbers to catch up to what they're doing. They're just persistent on raising the rates. It's almost like no matter what. And it's almost like they got their foot on the gas and they're approaching the traffic. And if they don't take their foot off the gas, they're going to crash. And the Federal Reserve got it wrong the first time. They said a year and a half ago or 2 years ago when we started seeing a little bit of inflation that the inflation was transitory. And what a lot of people are hoping, including me, is that they don't get it wrong a second time and keep their foot so far on the gas that now they crash into all the cars in front of them. And if that happens, they keep their foot on the gas for so long, the reality is that the stock market is going to wind up crashing because they've been too aggressive for too long. And what they're looking at primarily is the unemployment number. And that's the second reason that's going to keep inflation high is the unemployment number. The unemployment number right now is at 3.7%. In order for inflation to come down, experts have said that that unemployment number has to get between 4 and 6%. I think it's got to get above 5%. Right now, 4% is too low. It's almost at 4% unemployment right now. I think it's got to get closer to 6% in order for the inflation to come down. And the Feds are going to keep their foot on the gas and keep raising interest rates until that inflation gets down to their target level. Their target level's 2. There's a lot of people wondering when that's going to happen or if that's going to happen. When they get down to 3, I think maybe they're going to call it good, but they're still talking about a target level of 2% inflation. But the bottom line is this. The bottom line is that they've got their foot on the gas, and there's so many, right now the unemployment number has to go up in order for inflation to come down, and we're just not seeing that unemployment number move. Why? Because right now there's 1.7 jobs available per worker. So a worker can go out and find another job. There's just not enough workers out there. And that's the problem. So I think what this is going to lead to is the Federal Reserve is going to raise interest rates a few more times. They've raised interest rates a bunch this year, but they're going to raise them more next year. But at some point in time, there's likely to be a recession. And at that point, what's going to happen is they're going to be forced to start cutting rates. And what's going to happen to your portfolios is your portfolio values are then going to go up, just like they've gone down when interest rates have gone up. Well, they're going to go up when interest rates start coming down, and you're going to feel better about it. If you're reinvesting your money, the best thing that can happen to you is that doesn't happen. That's the worst thing you can happen. You want your portfolios to stay down at this point while you're reinvesting. If you're getting income, it doesn't matter. But from an emotional standpoint, how it feels to you, you're probably in the next year or two. It could be 6 months. I mean, we don't know. But at some point in time, I feel like you're going to see your portfolios come back up and you're going to feel better about it. We're investing for you for the rest of your lives. I'm not investing for you for the next 6 months, for the next year. We're investing for the rest of your lives. I just want to make sure you don't run out of income before you run out of money. And none of you are in that position because you're living off the eggs and not touching the chicken. So for next year, I do think that we're going to have a recession. I do think the stock market's going to have a major pullback. Right now, the market's down 20%. I could absolutely see it going down another 20% from here, which means down from 40% from its all-time highs. What does that mean to you? Nothing. Most of you have 10 to 30% in stocks now. If you have nothing in stocks now, it might not be a bad time to put small something. But if the market does go down another 20% from here, then you can count on me putting out another video, and you can count on me wanting to add more to your positions in the world of equities. So when the market bounces back, you then have the ability to bounce back with it. So stay tuned to the market. Stay tuned to my videos. And certainly I hope I've given you an outlook as to what's likely to happen. Recession next year or the year after, and I think the market's going to have some major problems ahead. For now, don't do anything, but certainly when the market does have problems, we'll make some changes then as well. Any questions? Feel free to call my office, and feel free to speak with either myself or Tuan. Otherwise, wish you all a Merry Christmas and a Happy New Year, and we'll see you all back here on January 3rd. God bless.